Stop whatever you are doing right now, because what the IRS just confirmed could save you hundreds or even thousands of dollars this year, and most seniors are completely unaware of it. If you are 65 or older, if you are retired, if you receive Social Security, a pension, or money from a 401k or IRA, then this video is one of the most important things you will watch all year. The IRS has officially confirmed, as of July 2026, that certain seniors and retirees qualify for exemptions from 5 specific tax obligations that millions of Americans are still paying unnecessarily. These are legitimate IRS-confirmed rules specifically designed to protect seniors and retirees from being overtaxed during some of the most financially vulnerable years of their lives. Congress passed these provisions, the IRS enforces them, and yet study after study shows that the majority of eligible seniors never claim them. Financial experts estimate that American retirees collectively overpay their federal taxes by billions of dollars each year, simply because they did not know these exemptions existed. If you are 65 or older and your total income falls below a certain threshold, you may not be required to file a federal income tax return at all. Now pay attention here because the numbers have changed for 2026. The standard deduction for seniors has been increased again, and for a single filer who is 65 or older, the standard deduction is now significantly higher than it is for younger taxpayers. For married couples where both spouses are 65 or older, that number climbs even higher. What this means in practical terms is that if your combined income from Social Security, a small pension, and perhaps some modest investment returns falls below the filing threshold, you could literally owe nothing and be required to file nothing. I want you to stay with me because the second exemption involves Social Security, and this one directly affects the monthly income that millions of retirees depend on. Many people believe that Social Security is always taxed. That is simply not true. Whether your Social Security benefits are taxed and how much of them are taxed depends entirely on what the IRS calls your combined income. Your combined income is calculated by taking your adjusted gross income, adding any non-taxable interest you earned, and then adding half of your Social Security benefits. If that total number is below a specific threshold, your Social Security benefits are completely free from federal income tax. Not partially free, completely free. For individual filers, if your combined income is under $25,000, none of your Social Security is taxable. For married couples filing jointly, that threshold is $32,000. So even if your combined income is slightly above those thresholds, only a portion of your benefits becomes taxable. And there is a firm legal cap that protects you from ever having more than 85% of your Social Security taxed, no matter how high your income goes. If you have been paying taxes on 100% of your Social Security, you may have been overpaying for years. If this information is helping you, or if you think it could help someone you love, please take 2 seconds right now and hit that like button below this video. And if you want to be notified every time we release an update like this one, go ahead and subscribe and ring that bell. We cover Social Security, Medicare, IRS changes, and retirement income topics every week. And the people who subscribe are consistently the first to know when something changes that could affect their finances. It is completely free, and it could be worth a great deal to you and your family. Now let's keep going, because the next 3 exemptions are where things get really important. The third exemption involves required minimum distributions, commonly known as RMDs. If you have a traditional IRA or a 401k, the IRS generally requires you to start taking money out of those accounts once you reach a certain age. For years, that age was 70 and a half. Then it was pushed to 72, and after the Secure 2.0 Act, it moved again. As of 2026, the required beginning date for RMDs is now age 73 for most people, and it will increase to 75 for those born in 1960 or later. Why does this matter as an exemption? Because if you turned 73 this year and you thought you had to start taking distributions immediately, you may actually have until April 1st of the following year to take your first RMD without penalty. That grace period is often overlooked. More importantly, if you are still working and contributing to a workplace retirement plan, you may be able to delay RMDs from that specific plan even longer, as long as you are not a 5% or greater owner of the company. This is a legitimate IRS confirmed deferral that thousands of seniors miss. Every year you can delay an RMD is a year that money continues to grow tax deferred inside your account. If you are 65 or older and you sell your primary residence, you may qualify to exclude a substantial amount of the profit from capital gains taxes entirely. Under current IRS rules, a single filer can exclude up to $250,000 in home sale profit from taxable income. For married couples filing jointly, that exclusion doubles to $500,000. The requirements are that you must have owned and used the home as your primary residence for at least 2 out of the last 5 years before the sale. What makes this especially powerful for seniors is the current real estate environment. Many retirees purchased their homes decades ago for a fraction of what those homes are worth today. A home bought for $150,000 in the 1990s might sell today for $500,000 or more. Without this exclusion, that gain could trigger a massive tax bill. With the exclusion properly applied, a married couple might owe absolutely nothing on that gain. If you're thinking about downsizing, moving closer to family, or relocating to a lower cost of living area, this exemption could be one of the most financially significant moves of your retirement. The fifth exemption is one that very few seniors know about, and it relates to a special tax credit called the Credit for the Elderly or the Disabled. This is a dollar-for-dollar reduction in your actual tax bill, not just a deduction from your income. And it is available to people who are 65 or older, or who retired on permanent and total disability and received taxable disability income. The credit can range from several hundred to over $1,000, depending on your filing status and income level. To claim it, you file Schedule R with your federal return. This credit has existed for decades. It is sitting right there in the tax code, available to millions of eligible Americans. And yet an overwhelming majority of seniors who qualify for it never claim it, either because they do not know it exists, or because their tax software did not flag it, or because they filled out their return quickly without reviewing all available credits. If you have never heard of Schedule R, pull up your last 3 years of tax returns right now and see whether it appears. If it does not, and you believe you may have qualified, you can file an amended return using IRS Form 1040-X for up to 3 prior years and potentially receive a refund check in the mail. The first mistake is assuming that tax software automatically finds every deduction and credit you qualify for. It does not. Most tax software asks you a series of yes or no questions, and if you answer them quickly or incorrectly, entire categories of savings can be bypassed without any warning. The second mistake is failing to account for all sources of income, or conversely, over-reporting income that is not actually taxable. For example, if you receive gifts from family members, those are not income to you. If you receive a life insurance payout after a loved one's passing, that is generally not taxable. If you withdraw money from a Roth IRA that you have held for at least 5 years, after age 59.5, those distributions are typically tax-free. Confusing these categories can cause you to either overpay or inadvertently underpay, both of which create problems. The third common mistake involves withholding. Many seniors have taxes automatically withheld from their pension payments, Social Security benefits, or IRA distributions. But if you qualify for these exemptions, and your total tax liability is actually lower than what is being withheld, you are essentially giving the government an interest-free loan every month. You can adjust your withholding at any time by submitting a new W-4P form to your pension administrator, or by calling the Social Security Administration to adjust withholding on your benefits. Getting your withholding right means more money in your pocket every single month, rather than waiting until April to get a refund of money that was rightfully yours all along. Let's also address something that causes enormous anxiety among seniors, and that is the fear of IRS penalties. If you discovered through this video that you may have missed an exemption or underpaid in a prior year, it is far better to address it proactively than to ignore it. The IRS has programs specifically designed to help taxpayers come into compliance voluntarily, and the penalties for voluntary disclosure are always significantly lower than the penalties that result from an IRS audit or investigation. More importantly, if you believe you overpaid in prior years, you have every right to file an amended return and claim what is owed to you. The IRS is not your enemy in this process. They have a dedicated helpline for seniors called the IRS Tax Counseling for the Elderly program, which provides free tax preparation and advice through certified volunteers who specialize in senior tax issues. You can find this program, known as TCE, through the IRS website or by calling 1-8008 291040. Imagine a retired couple in Ohio, both age 70, whose income consists of $30,000 in combined Social Security, $12,000 from a small pension, and about $8,000 in annual IRA withdrawals. Their total gross income looks like $50,000 on paper. But once you apply the Social Security tax formula and determine that only a portion of their benefits is taxable, once you apply their increased senior standard deduction, and once you factor in any eligible credits, their actual taxable income might be dramatically lower than $50,000. In many scenarios like this, a couple in that situation would owe little to nothing in federal income tax. This is the reality for an enormous number of retirees across America right now. The tax code has been quietly updated. The IRS has confirmed these exemptions are in place, but the information has not reached the kitchen tables, the retirement communities, and the mailboxes where it needs to go. That is the entire mission of this channel. We believe that every senior deserves to keep more of the money they worked their entire lives to earn and save. You paid into the system for decades. You followed the rules, you raised families, built businesses, served your communities, and contributed to this country. The idea that you should continue overpaying your taxes in retirement simply because the information was not made accessible to you is something that we refuse to accept. First, pull out your last 2 or 3 tax returns and look at them with fresh eyes. Check whether Schedule R appears. Check what percentage of your Social Security was reported as taxable. Check whether your standard deduction matches the higher senior amount you are entitled to. Second, if you have not already done so, calculate your combined income using the formula we described and see where you fall relative to the Social Security taxation thresholds. Third, if you are approaching age 73, speak with a financial advisor or tax professional about your RMD strategy before your required beginning date arrives. And fourth, if you sold or are planning to sell your home, get specific advice about the capital gains exclusion and how to time the sale to maximize your protection. The IRS has confirmed these 5 exemptions are real, they are in effect for 2026, and they are available to qualifying seniors right now. But they will not come looking for you. You have to know to ask, you have to know to look, and that is exactly what you are doing by watching this video today. Whether you save $200 or $20,000 as a result of what you learned here, the knowledge you gained today has real value. Share this video with your spouse, your siblings, your friends at church, your neighbors in the retirement community. You never know whose financial life you might change by simply passing along this information. We will continue to bring you updates like this every time the IRS, Congress, or the Social Security Administration makes changes that affect your retirement income, your benefits, your taxes, and your financial security. Because in a world that changes fast and does not always send you a memo, staying informed is not just smart. It is survival. Stay with us, stay informed, and remember, the money you worked for deserves to stay with you.